All righty. Good morning, everyone. And it is a good morning, a beautiful morning, in spite of the fact that there is a sea of red showing up on all the major American indexes again today. And what do we do when we have a small account and we want to protect our positions, or we want to, how can we take advantage and maybe make some money while a market is falling or while a stock is falling? And so that's going to be our topic for discussion today. We're going to talk about how we can perhaps hug a bear or embrace this bearish time in the markets and come out not bleeding and wounded, because we felt a little beaten up this year, haven't we? So welcome to Trading a Smaller Account. My name is Barbara Armstrong. I'm a coach with Schwab. If you are not following me in the land of X, formerly known as Twitter, I formally invite you to do so. My handle at Barb Armstrong CS, and at Connie, we've got Connie Hill with us in the chat. She's a friend and fellow coach. So at Connie Hill CS, she posts lots of great stuff on a daily basis. Know that I have a tendency, how some people tend to get bronchitis or sinus infections. I tend to get scammers on Twitter or X. And so just know that I will never reach out to you and offer you a Bitcoin or a crypto deal, private education for a fee, or the scariest one of all. I won't ask you to trade on a different platform other than Thinkorswim. I won't suggest that you give me access to your account so I can trade it on your behalf. These are thieves. So no coach will ever do that. Just wanted to be aware, because I've had probably 4 or 5 imposters in the last month. So as we get going, just know options carry a high level of risk, aren't suitable for all investors. We use the Paper Money software application on the Thinkorswim desktop platform. It is a brilliant place to learn and hone your trading skills before you consider trading in a live account. There are some nuances and differences. One is that short options will never be assigned early in Paper Money. That can happen in a live account. And know that everything we talk about in this class is for educational purposes only, none of it to be construed as a recommendation. We started out the year with 25,000. Our max risk per trade is 500. And our focus in this class I think I've been teaching this class now for 6 years. And for those of you, I don't know if there's anyone here that is brand new. But I started as a client back in 2011, joined as a coach in 2016. And I don't know, I think I've been teaching this class since maybe 2017 or 18. So it's been a long time. And we've really grown this. We have quite a community now. And we've had a lot of fun together and a lot of successful example trades over the years. Okay, so, and I want to just thank all of you who come on a regular basis and bring this class to life. There were some really thought-provoking questions before we even started today. And so what we're going to do is a bit of the yin and the yang. We're going to look at some bullish strategies. We're going to look at, our focus is going to be more on bearish strategies, but we're going to look at how we might take advantage of this current time frame that we are investing within. And just let me start by coming and looking at some of these questions, because there have been a ton of them. Someone's saying, I'm having the worst entries on trades. And you don't want to be chasing the bus, but you don't want to be over anticipating an entry because you think it's going to happen and then have it not happen. So, there's a delicate dance there, and we can talk about that. We can talk about that as well. Just let me scroll up again in the chat. Somebody asked if I had any idea of why the market was moving bearishly today. And if we come and we look at a 1-day, 1-minute chart on the SPX, like this looks like a ski hill to me, but the last few minutes, this is 1 day, 1 minute. So the last 8 or 10 minutes, it seems like things are rebounding a little, but another down day in the markets. We're down almost 1% so far today on this index. And, when we look at the last 6 months, so, I joke about Chicken Little, and I don't know why I see Chicken Little as a woman. It could be either sex, I guess, but we're now down 7.5%. So, Chicken Little is out in the yard doing laps, and people are paying attention. People are paying attention because, although we hit a new all-time high on this market back on February 19th, it came back and, has broken below this support level. It's now below the 10, the 30, and the 100-day moving averages. If we were to add a 200-day moving average, let's go. We can come up here to edit studies and then just type in simple moving average, or start to type it in. We're going to add that. And then if we come out to our sprocket, the default is 9. So we're going to change that to 200. I'm going to leave it green because we don't have a green index. Not that I want this to be so cluttered, but it's now broken below the 200-day moving average. And for a lot of people, the 100-day moving average is significant. The 200-day moving average, ouch, very significant. So all is not well, many might argue. And if we look at the NASDAQ, and I'm not spending as much time doing a market analysis, but I think it's important that we spend a couple of minutes talking about what's going on here before we look at how we might want to approach our account. And this is now officially in recession territory. We're down over 10% off that February 19th all-time high for the market. We've broken through every timeline, like every moving average that I have here, including the 200. And it looked like this 200-day was going to act as a support level, and then, ouch, it's broken below that as well. So, there's a lot of blood running in the streets, and when we look at the Dow, similar. Now, it's still above the 200-day moving average. Well, yippee skippy. Still pretty down. And when we look at off its high here, it's down 6%. So down less than the others, but still not looking so hot. And then when we look at the volatility index, we are not surprised. And, we've spent most of the last year under 20, and look at this last week. So markets tend to like stability and predictability. And one of the things that this year has been characterized by is, a lack of stability. And, it hasn't been boring, I'll grant you that. But all this tariff stuff has really shaken things up. So let me just come to my comments and make sure I'm looking at what's current. Yeah, so, there's a lot of uncertainty, and somebody has, George typed in, there's a whipsaw on policies, there's a lot of uncertainty, there's a lot of, lack of trust. And I would say that, that about sums it up. And so when you're feeling you can't trust what's going on, you take your money and you tend to put it in places where you feel there's more trust. And one thing I'd recommend, so the class on Friday mornings at the Market Open, which is typically taught by Kevin Horner and James Boyd. Today it was James Boyd and Brent Moores, and unfortunately it won't be archived, but what a great discussion about where money's flowing. So you may want to add that class to your curriculum going forward, because it really is fantastic. And they showed that a lot of money is being pulled out of American markets. Now, even within those markets, like, all is not doom and gloom. And so we talked about that yesterday in the after hours class, and we teed up 3 trades, one on Hershey's. So you may not want to spend money on maybe doing a big home renovation, but people are still buying chocolate, so it would appear. And that kind of moved nicely today. And Mickey D's, and this is not a recommendation to buy the stock or to go and have yourself a Big Mac attack. But that stock has done pretty well today, also kind of breaking out above this previous high. So, maybe it's an affordable indulgence. And what one of the comments made in the chat that I thought was very insightful was that even though this is an international company, if you have a McDonald's in Toronto, you are sourcing your wrap for your burgers and your clamshells and everything from a Canadian supplier. And if you're in France, so everything is within the country in which it operates. And let me just go out, just out of curiosity, how many countries is McDonald's in? Any guesses? I was going to say it has to be over 100. It's 120. And they still serve 68 million customers a day. So AJ, the Trader Talks class is every day at the market open. And the one that's specific to ETFs, which is unfortunately not archived, that's on Fridays. Okay. Yeah. So anyway, like all is not doom and gloom. And then the third one we did yesterday, and this was in the trading after hours class. So if you haven't been coming to that class, you may want to check it out. It's at 4:00 Eastern. I know that's not an ideal time, but we're pretending that we inherited $1 million as opposed to the 25,000 we started out with, and we're kind of building a portfolio. And with these examples, we were using callers as a way to get in and feel like we're getting in, but we're wearing a suit of armor while we're entering the fray, right? Right. Okay, so what are we going to do in this class? Well, let's look at Home Depot. Okay, so Rob is saying, yeah, time to make money in puts. So nice segue. Nice segue. But one thing, and we are going to talk about some put strategies today, but remember the VIX? Where is it? It is high, right? So when the VIX is so high, might this be a good time to sell? Okay, I'm listening. Well, actually, I'm the one doing the talking. But, could we come up here and say, well, Home Depot, like so many other stocks, just let me get my drawing tool. It had this support level around this 383-ish level, right? And it came down once, twice, 3 times late. It came down a 4th time, 5th time, it broke. And it didn't just break. I mean, it crashed through that support level. Now, it could be just an anomaly and it may, come back around and hop back over the edge, and say, whew, okay, I had a little trip to the downside and now I'm ready to come back above ground. But it's not unusual to be loved by anyone. Sorry, I've got songs going through my head. It's not unusual, for an old support level to become a new ceiling. So could we kind of take advantage of the fact that volatility is high on the high right now, say, even though this is at 370, could we maybe come and sell something at like 385 and sell a call and do a short call vertical where we're selling a call and then we're buying a call above it to define our risk? Okay, so let's go and see. So yeah, so we're trying to take advantage of the volatility and use that to our favor. And and someone else is pointing out like, oh my God, you guys are so smart. I like this. I'm so used to looking for bullish patterns. I just pretend that line's been extended. What do we have here? Not a ghost, a big fat head and shoulders pattern. And I tend to post patterns daily on X, so you're missing out, my friends. So look surprised when you see this later on X. Feel free to like it or comment, but it's broken down below this. And so some might say, well, if we're looking for a target, we measure this range. But what if we're saying, hey, we just want to, we're just anticipating that this might stay below that 385. Okay. I like the way you're thinking. And Isaiah said the same thing. And Barbara. And yeah. Okay, so let's come to the trade tab. So we're going to come out, like if we look out 21 days, and if you look at the example trading plan for this, do you trade more than 1 million shares a day? Yes. Do you have at least 20 times the number of contracts? Well, yes. And this is a weekly. Now, what's the advantage of doing a weekly? Well, a weekly time decay is going to be accelerated. And we're selling something, we want to get paid and then have it go down quickly in value. If we come out 41 days, we have more contracts, 144 versus 66, but we have a similar, this is 30 cents. This is 30 cents. So a similar bid-ask spread, but we're in this for almost twice as long. And we're probably not going to get twice as much premium. Well, let's just see. So if we go 385 and we're looking to sell a vertical, 390, we get $1.15. Now, do we get twice as much if we come out to April? No, we get like not even 50% more. And so some might say, well, the advantage of going out to April is that I have more time to recover if the trade goes against me, and that is true. But the disadvantage, the advantage of the 28th is that if you are, right, if you are correct in your analysis, you'll hit your target faster, perhaps. So in our example trading plan, our target is that we want to exit this when we have 80% of our max gain. Now, if on Monday this tanks, and by the time we get together for this class again on Monday, we've got 50% of our max gain, might we just say, hey, we got 50% of our max gain in one trading day, we're going to take it? Well, absolutely, we might do that. So we are going to right click and say, hey, when this is worth about 23 cents, that's about 80%, we'd like to buy it back. And we reserve the right to change our mind and exit earlier if we've got, a nice gain in a shorter amount of time. Okay, so we're going to put this in our short call vertical bucket. Okay, and we know that we are choosing a non-standard, in other words, a weekly expiration date, which has less liquidity than the monthly. Okay, so that is the depot. How about we come now and look at CRM? And one of the questions I get asked a lot is, well, when do you choose a short vertical versus choosing like a short call vertical versus a long put vertical? And so had we been having this conversation back here, maybe on March 3rd, maybe we would have come up here and said, hey, could we sell this 315-ish? And we could still come up here because volatility is high, because we had, again, this similar. And for those of you, if you're new to this whole like looking at charts thing, feel free to join me on Tuesdays at high noon. We do a getting started with technical analysis series, and you might find that helpful. But we again had a support level here, and it came up into the hood again here, and then it broke down, and old support looking like it's now acting like the new ceiling or new resistance level. And again, we may be seeing more of these. And actually, I'm sorry, I I should change that, because I think that it's part of human nature to be inherently bullish. And so I maybe shouldn't have a smiley face. We should have a sad face on that, but it's broken down. And so some might say, well, I just, if I'm going to do a short call vertical, it's going to be based on probabilities. Some traders say, I like to have as many levels of, resistance between me and my strike. So you could say you'd have a resistance level here and a resistance level here. So we could do that. And, it's now broken below the 200. It flirted with it, tried to hold, fell off the ledge. And so let's look at that. And then let's look at a long put vertical, which is a little more directional. Okay. So if we say, well, we definitely would want it to be above this level, this 293. So could we come out and sell the 295? And we've got 80 contracts here, or even the 300. Would we get enough premium? Okay, so if we look at this 295 and the 300, well, that's about a 25% return, right? We're risking $4 to make one. So that's a 25% return. And so we wouldn't get enough premium to sell the 300 and the 305, but we have $20 worth of wiggle room because it's already at 275. Now, our rule of thumb in our example trading plan is that if we're in it for 20 days, we want at least a 20% return. And some might say, well, no matter what, I'd like a 25% return. So we're looking at being in it for potentially 21 days. And we're looking at about a 25% potential return. So we're going to do one contract, single order, first trigger sequence, right click, opposite order, say, hey, when this is worth about 20 cents. Okay, so on this, we're putting in our target and not an exit. And why are we doing that? It's because we want to be able to look at this and make an informed decision that if it turns around and it starts going up, or if it turns around and it starts going against us, as the short put vertical we did on Microsoft did, it broke that support level and didn't look like it was coming back. At this one, if all of a sudden it rallied and broke the ceiling or the resistance level, we might go in and say, hey, you know what? This, bully for CRM, but we were thinking it was going to stay below 295. And so we're going to exit. And we're going to look at a long put vertical also, and we'll compare them. Okay. So we're going to go ahead and put this one in. 96. Okay. Let's see if we can get our dollar for that. I shouldn't have done so much talking. We definitely won't get $2. Okay. Just looks so much tidier. So, and I'll make sure that we get that filled. So that's our short call vertical bucket. Okay. Yeah, so Torrance, we will be watching these. Now, let's come back and look at it. It's trading at 276. Might we expect this downtrend to continue, since it basically started up here on January 28th, and we've been seeing just this string of bear flags since, right? Typically, the rally since January 28th has never been more than 2 days long. 2-day rally and a down day. 1 day rally, 5 days down. 1 day rally, down. 1 day rally, down. 2 days down. So, we wouldn't be shocked if we saw it rally for a day. But we're going to come and look at the put side now and say, okay, could we buy the 280? And that's a little rich for our blood. We don't want to risk more than $500 on any one trade. And so if we sell the 275, then it's helping fund the purchase of the 280. It's maximizing how much we can make, so it's limiting our gain. But it's a way that if you have a small account, or even if you have a bigger account, and you want to protect yourself. So when we look at this, just because I just as soon have the system do the math for us, how much could we lose on one contract? $263. How much could we make? $237. Well, our rule of thumb is if we can make 50%, we don't need to make close to 100. We're saying, like, if we could get out of this at 396-ish, we're leaving some money on the table, but we're okay with that. We'd rather have a little win. And last year was our most successful year in this trading a smaller account class. Prior to that, the year that we had the most success was the year that the S&P was down 18%, I think, about 3 or 4 years ago. And the year the NASDAQ was down almost 30. And we did a lot of very short-term trades. We weren't greedy. I said, don't be a greedy guts. That was an expression my family had as a kid. So we're going to go back and say, hey, I'm going to put in an exit. And if we're either up 50% or down 50%, we would like to take the money and run. But we're just putting in our target because with this much volatility, crazy things can happen in the market. And we don't want to get nicked out for a way bigger than 50% loss. But if we get nicked out for a 50% gain, we're okay with that. So, okay. So we're putting this in our long put vertical bucket. And we're going to compare this to our short call vertical. Now, what's the difference between these two strategies? Well, one, we're already quite a ways through. We did the 280 and the 275. So this only has to go down by another $1.50 and stay down by that much for us to have a successful trade. Okay. Now with the short call vertical, it just has to stay below the strike so it can go sideways. And we've got like 20 bucks worth of wiggle room on this because on this one, our strikes were at 295 and 300. So as long as it stays below 295, it's almost, well, it's what, $18 below that now. Okay. So, and this is March 28th. Okay. So the long put vertical is going to be more directional because it was, we can put this one on the charts too. So, and it was 280 and 275. So I'm putting the strike on the chart that we're aiming for. We're aiming for it to go below 275 and stay there. So 280, 275, and again, this one is March 28th. Okay. And so, and then we can compare those going forward. So that is CRM. Okay. How about we look at Amazon? Now, what does Amazon do? Like, and I know it sounds like, Barb, have you been living under a rock? And no, I have not. But like, let's just think about what they do. They're moving like tons of goods and services. And with all this trade talk, and some of the stuff I order from Amazon, it's not super pricey. But might people, if they're feeling like, you know, inflation, they're having to spend more money buying at groceries at Kroger than the discretionary items, might that have a downward pressure on, continue to have a downward pressure on Amazon, even though they do what they do very well. And, you know, since again, February 5th, you know, this stock that has been so extraordinarily successful, like look at the last 2 years. Excuse me, like just eyeballing it, like that's close to a 300% rise, right? In 2 years. Like, holy smokes, Batman. Like, that's pretty fantastic. Well, not quite 300. It's a mere, oh, sorry, I have to draw the line the other way. Only 169%. How was that from 88 to 240? Well, okay. So, you know, but it's now we're seeing this series of bear flags and it's broken below this previous support level. And where did that come from? Well, you know, or even if I draw the line down here, I think there was like a cup and handle pattern or something on the chart. Yeah, we had this cup and handle pattern and then it broke above and kind of came back. But support and resistance is a range. So if we look at this and we say, you know, even if I move this line, well, here we can just take and move this line. I'm going to activate it. And we move it below here, which is maybe a little more accurate anyway. It's still breaking below that and breaking below the 200-day moving average. So could we look at this and do a long put vertical? You know, and say, I'm not hearing or seeing anything that might lead me to believe that there is an imminent change coming that might have a positive impact. You know, and maybe I'm hearing different things than you're hearing. In all honesty, I watch very little news. It's a way of protecting my optimistic outlook on life, I think. But yeah, so could we look at this and say, okay, could we buy the 190 put or buy the 195 and maybe sell the 190? Like it would have to come down another $3. And, you know, how might that work out? And could we could come out to April for that? You know, this is a stock, like look at even the weeklies are super heavily traded. Now, what's the advantage? And let's do, you know, since we're in comparison mode, if we're looking at the 195, and again, that's kind of out of our snack bracket because we could lose it all if we buy any option. We've got a 10-cent bid-ask spread, thousands of contracts. So if we come here and say we are going to buy a vertical, $2.10. So we say, okay, well, if this gets up to 315 and I'm just multiplying 210 times 1.5, that's a 50% gain. So if it goes up to 315, I'd like to take the money and run. And we could do 2 of these and we're still not risking more than $500. So we're going to come to first trigger sequence, right click, opposite order, and make this 315. Are we leaving money on the table? We are. Why are we doing that? Because we don't want to be greedy. We'd rather take little win and then we can wash, rinse, repeat, do it again, or little loss, live to trade another day and come back in and do it again. Okay. Confirm and send. We're going to put this in our long put vertical group and we're going to compare this to the March expiration. So let's look at March, or sorry, April. We are in March. So a further dated expiration. So if we come out to April, oops, didn't want to bring that up. If we come out to April, so now instead of 21 days, we're doubling the amount of time. My expectation as a trader is that this might take longer to reach its target, but if it really moves down dramatically, we might get out at both at a similar time, but it'd be interesting to compare them and just see whether they continue to move bearishly, or if they rebound, how the time component of it impacts our potential profitability on the trade. So again, we're going to look at that 195 and the 190. Now, could we do the 200 and the 195? We could. In fact, let's just see out of curiosity, this is $2. And so we'd want to be out when it got to $3. Let's look at if it's already through both strikes. If we did the 200, like how much would we have to pay for one that's already where we want it to be? Well, we'd have to pay $253. So we're risking $258 to make $242. Like that's almost 100% return. And all it has to do is stay below 195, which is where it already is. So this is a directionally, typically bearish trade, but our break even on this is 197. And so as long as it stays below 195, which it already is, we're good to go. Our break even on this is 197.45 for a bearish strategy. Well, that's not too tough to a pill to swallow. So we're going to come to our single order first trigger sequence. And how many of these could we do? Well, we could do 2. But I think we just did one of the other one, didn't we? Oh, we did 2. Well, let's do, because we already have a trade on here, we'll just do one of these. Okay, because we're risking 400 on these two. But we're doing this for comparison purposes. So we're going to make this 375 and make that good till canceled. Bob's your uncle. By the way, like the first time I said that, and being a Canadian, Canadians use a lot of British expressions. And somebody said, "Who is Bob?" And so I Googled it. And Bob actually was a member of Parliament in England compared to March expiration. And he got his nephew a really cushy job. And so it became kind of an expression to say, hey, it's easy for you. Bob's your uncle. So just if you're wondering. Now, I've referred many times to these example trading plans. And you may be saying, like, where are these example trading plans that you keep referring to? So let me show you. So I created, and this is where, you'll want to hit that button in the bottom right corner and subscribe to the channel if you haven't already done that. Because this is what you're subscribing to. It's free to subscribe, Trader Talks from Schwab Coaching. And when you first come in here, you'll see whatever class is currently being taught. And then if you come to playlists, it is now, I used to say, look for the pink kind of thumbnail. It's now turquoise. And I've just started creating a series of candles, of short sessions. You'll see this is 5 minutes. My goal is for all of these to be under 5 minutes. And it's a candlestick pattern series. Here's number 1, what's a hammer? So if you're new to technical analysis, when I was learning this stuff, I would have been binge watching these and just gone from one to the other. I'm 1 deep so far, but I've got a list of, 18 to 20 that I want to do. And the same with these example trading plans. So we did a short call vertical today. In fact, we did a couple. So here's an example trading plan for short call verticals. And then here's an example trading plan for long put verticals. And, we go over, why our goal is what it is and when we want to get, when we're getting out, both if the trade goes for us or against us. And so you'll see this list continue to grow. It's grown more slowly than I would have liked, but we've got, more than half a dozen in there. I just added one, a simple stock investing plan, just less than 2 weeks ago. But this is something, again, that I would have really appreciated having as a client and did have as a client. And then I took the example trading plan and I made a checklist for every trading strategy. Yeah, bit of a nerd, but it worked for me just to make sure I wasn't missing anything. You know, it's like, oh, does it trade 1 million shares a day or more for a long put vertical? Yes. You know, is the bid ask spread less than 10%? Check. Do I have 20 times the number of contracts? Like if those are part of your trading plan. Now, you can create your own trading plan. This is just a template. Okay. Yes. Now, somebody's saying, do these explain what a short call vertical is? So this is actually an intermediate level class. So I'm assuming that you understand what all these strategies are. However, if you don't, here's a list. And you know, this getting started with option series, I taught this for, I don't know, since I became a coach, actually, within about a year. So I've taught it for a long time, but we have a different class. So here's short call verticals. This assumes you have no clue what it is. Okay, so you can watch that. I'll put a link into this playlist and the mini session playlist. And then there's also one for short call verticals right here. So there's short call verticals, and then there's one for long put verticals. There's 10 different strategies. And then if you've never watched this 7 things I wish I'd known about trading, I'd highly recommend that you check that one out too. Okay. So that's a wrap for today. Just before we go, here's what I ask of you. One, I don't believe there is a survey today, but one of the things I get asked often when there is a survey is, would you review what trades you placed? So here we are reviewing the trades we placed. We did 2 trades on CRM that we're going to compare. So we did a short call vertical above where it's currently trading. And then we did a long put vertical, which is a little more directional, on that same stock. On Home Depot, on the Depot, we did a short call vertical. So these are all bearish strategies. And then on Amazon, we did 2 long put verticals, one expiring in 20 some days, 21 days. And then one with a further out expiration expiring in 41 days. And we're going to compare them. Okay. And the strikes are similar, not exactly the same, but I think that will lead to an interesting conversation. And in that trade management mini session playlist are some, you know, I call them postmortems on some of these comparison trades. And if I do one, I will let you know in class that that's where I put that information, just so that we have more time to do active trading as opposed to postmortem analysis. Okay. So those will be there as well. So hit the like button. It helps move things up in the algorithms. If you haven't had a chance to do a favor for anyone today, you could be helping out a random stranger by hitting the like, because it helps more people find this content. It also lets Connie and I know that you found this to be helpful. Hit the subscribe button. Follow Connie and I in the land of X, Connie Hill CS, Barb Armstrong CS. And have yourselves a great weekend. Get out there and hug someone you love. I will see you Monday for the next Trading a Smaller Account. Take care, everyone. Bye for now. Thanks to Connie for being so great in the chat and the guys behind the scenes as well.